Here's something that might shock you. If you invest your first $1,000 at age 25 and never add another penny, you could have over $21,000 by retirement. But here's the catch: 60% of Americans have less than $1,000 in savings, and most who do have it sitting in savings accounts earning basically nothing. Today, I'm going to show you exactly how to put that first $1,000 to work. Welcome back to Cashflow Kingdom, where we break down personal finance without the jargon. I'm here to help you build wealth one smart decision at a time. In the next 11 minutes, you're going to learn the exact step-by-step process to invest your first $1,000, including where to open your account, what to buy, and the biggest mistakes to avoid. Even if you've never invested a single dollar before, by the end of this video, you'll have a clear roadmap to get started. Hold up, before we dive into investing, we need to make sure you're actually ready for this step. Think of investing like building a house. You wouldn't start with the roof, right? First, you need a solid foundation. Here's your quick checklist. Do you have at least $500 to $1,000 in an emergency fund separate from this investment money? Are you paying more than 15% interest on any credit cards? If you answered yes to high-interest debt, stop right here. Pay that off first. There's no investment that consistently beats paying off 20% credit card interest. But if you've got your emergency fund and no high-interest debt, congratulations. You're ready to make your money work for you. This foundation check might seem boring, but it's the difference between successful investors and people who panic sell their investments when life happens. Now let's talk about where to put this money. You've got three main options, and picking the right one could save you thousands in taxes over time. First up, a taxable brokerage account. This is like a regular investment account. You can put money in and take it out whenever you want, but you'll pay taxes on any gains. Next, we have the Roth IRA. This is my personal favorite for beginners. You put in after-tax money, but then it grows tax-free forever. The catch? You can only contribute $6,000 per year, and there are income limits. But here's the cool part: you can always withdraw your contributions penalty-free. Finally, there's the traditional IRA, where you get a tax deduction now but pay taxes when you withdraw in retirement. For most people watching this video, I'd recommend starting with a Roth IRA. You're probably in a lower tax bracket now than you will be later, so paying taxes upfront makes sense. Alright, so where should you actually open this account? The good news is that most major brokers now offer commission-free trading, so you won't get nickel and dime to death. Here are my top picks for beginners. Fidelity and Charles Schwab are the gold standard. They have excellent customer service, great educational resources, and no account minimums. Vanguard is fantastic if you want to focus on low-cost index funds, though their website feels like it's from 2005. For the tech-savvy crowd, there's Webull and Robinhood, but honestly, I'd steer clear of these for long-term investing. They're designed to encourage frequent trading, which is the opposite of what we want. If you want a more hands-off approach, robo-advisors like Betterment or Wealthfront will build and manage a portfolio for you. They charge a small fee, but they handle all the rebalancing and tax optimization. My personal recommendation? Start with Fidelity or Schwab. They're boring in the best possible way: reliable, cheap, and focused on long-term investing. If this breakdown is helping you feel more confident about investing, smash the like button and subscribe for new money tips every Tuesday. Here's where the magic happens: what to actually buy with your $1,000. Forget about picking individual stocks or trying to find the next Tesla. I'm going to share the same strategy that Warren Buffett recommends: low-cost index funds. An index fund is basically a basket that holds hundreds or thousands of stocks, giving you instant diversification. Instead of putting all your eggs in one company's basket, you're buying a tiny piece of the entire market. For your first $1,000, I recommend starting with a total stock market index fund like Fidelity's FZROX or Vanguard's VTI. These funds literally own pieces of thousands of companies: Apple, Microsoft, Amazon, but also smaller companies you've never heard of. The expense ratio is incredibly low, usually under 0.1%, meaning you keep more of your returns. Here's what's beautiful about this approach: you don't need to research companies, time the market, or stress about individual stock picks. You're basically betting that the American economy will continue to grow over the long term, and historically, that's been a pretty safe bet. So you've got your $1,000 ready to go. Should you invest it all at once or spread it out over time? This is called the lump sum versus dollar cost averaging debate, and there's actually some solid research on this. Mathematically, investing the lump sum right away wins about 60 to 70% of the time because markets generally go up over time. But here's the thing, we're not robots, we're humans with emotions. If you invest all $1,000 today and the market drops 20% next month, how are you going to feel? If you're the type who'll panic and sell, then dollar cost averaging might be better for you psychologically. You could invest $250 every week for 4 weeks, or $100 every 2 weeks for 10 weeks. This smooths out the bumps and helps you avoid the regret of investing at a temporary peak. My recommendation for beginners? If this $1,000 represents a big chunk of your net worth, go with dollar cost averaging. If it's money you truly won't miss and won't lose sleep over, invest it all at once and start building that investing muscle. Here's the secret sauce that separates successful investors from everyone else: automation. Once you've made that first investment, you need to set up automatic contributions. Even if it's just $50 or $100 per month, consistency beats perfection every single time. Think about it, if you invest $100 per month for 30 years with average market returns, you could end up with over $200,000. Most brokers make this super easy. You can set up automatic transfers from your checking account on the same day you get paid. I like to do this right after payday, before I have a chance to spend the money on something else. This is called paying yourself first, and it's how regular people build wealth. The psychological benefit is huge too. You stop thinking about market ups and downs because you're consistently buying. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this averages out to solid returns without the stress of trying to time the market. Before we wrap up, let's talk about the biggest mistakes that trip up new investors, because knowing what not to do is just as important as knowing what to do. Mistake number 1: trying to time the market. You'll see headlines about crashes coming or bubbles bursting. Ignore them. Timing the market beats timing the market every single time. Mistake number 2: checking your account too often. If you're logging in daily to see how your investments are doing, you're setting yourself up for emotional decisions. Check quarterly at most. Mistake number 3: chasing hot stocks or the latest trends. Your boring index fund will likely outperform 90% of actively managed funds over the long term. And finally, mistake number 4: not increasing your contributions as your income grows. When you get that raise or bonus, bump up your investing accordingly. Remember, this is a marathon, not a sprint. The goal is to build wealth steadily over decades, not to get rich quick. And just to be crystal clear, this is educational content, not personalized financial advice. Always do your own research and consider consulting with a financial professional. And there you have it, your complete roadmap for investing your first $1,000. Let's recap the key steps. Make sure you have your financial foundation in place. Choose between a taxable account or Roth IRA. Open your account with a reputable broker like Fidelity or Schwab. Invest in a low-cost total market index fund, and set up automatic contributions to keep the momentum going. The hardest part is often just getting started, but once you take that first step, you'll be amazed at how your confidence grows along with your account balance. What questions do you have about getting started? Drop them in the comments below. I read every single one and often turn your questions into future videos. And if you want to dive deeper into building wealth, check out this video on emergency funds or this one on increasing your income. Thanks for watching Cashflow Kingdom, and I'll see you next Tuesday.